Let's go.
Riches in the Hitches is the RV park investment podcast that pulls back the curtain on the outdoor hospitality industry. Each episode delivers real insight from park owners, investors, and industry leaders who are shaping the future of RV parks. From raw land development to scalable operations, we break down the strategies, stories, and decisions behind successful investments. If you're ready to learn from the people driving this industry forward, welcome to Riches in the Hitches.
So I am Robert Preston, CEO, founder of Unhitched RV, and I'm honored and privileged to have Landan here from North Star today. And I'll introduce Landan in just a second, but I will caveat with Landan is our first broker to be on the Riches in the Hitches. In the past, we've had primarily park owners and managers, and so I'm super excited to have Landan on today and to hear your story and to get a totally different perspective of what's happening. Landan, welcome to Riches in the Hitches.
Thank you for having me. I'm very excited to be here.
Awesome. So before we get into what's happening today, Landan, you started an entire brokerage yourself. Love to hear how you got there and why you chose a lot of the RV MH industry, and what is North Star?
Absolutely. And I've told this story to a lot of folks now because it's the first year of this brokerage's existence. I've worked at several other brokerages before, and I really liked the last company that I was a part of. A lot of people were shocked when we left to do our own thing. But what I've told everybody is that North Star exists today not out of desire. It's 100% out of necessity. Okay. My background is not in outdoor hospitality. It is today, but my background is in national retail brokerage. So I've sold a lot of retail in a lot of different states all throughout. Primarily the Southeast was my focus. We got into the outdoor hospitality space, I say by accident, because when I was on the retail side of things, we noticed a very high demand for 1031 exchange buyers coming into the long-term net lease retail space because they were primarily looking to exit management-intensive properties and exchange their equity into something that's extremely more passive. The prototypical client was typically someone who was 65 years of age or older, who is thinking about slowing down, management responsibilities, and then who had owned a property for 15, maybe 20 plus years, and tax mitigation was at the forefront. So they were looking to defer, if not avoid, their tax payment altogether, while also establishing a long-term cash flow. So for a long period of time, I found myself partnering with other brokers not in my retail space. So multifamily brokers, land brokers, industrial guys, all who were on the investment sales space. They had clients who fit that criteria and they wanted to help them sell their properties. But that one sticking point always seemed to be that they were reluctant to sell because they were going to have 25, 30+% of their equity go right to the IRS, and now they don't have any income coming off of it. So I was literally going on pitches with these brokers to their pitching to their clients with them to say, hey, he'll help you sell your multifamily property. I'll help you on the up leg. He can give you the best advisory services there. I can give you the best advisory services here. You get the best benefit. It doesn't cost you anything extra. And started doing a lot of that. And then I found this wonderful graph. I forget the company who put it out, NAREIT maybe. But it did a 20-year study that showed what property, it was a CPPI chart, commercial property price index. So it showed asset values and how they increased and decreased over time. And from 2000 to 2008, it was up and to the right? Sure. Period of high appreciation. Then 2008, great financial crisis, property values just tanked 30 to 50%, depending on the property type and then the market. And then it took a period of 5 to 10 years to regain that momentum, depending on the asset class. And all the assets over that period of time were appreciating to a degree, all to different levels and all at different rates. But the one asset class that had appreciated more than everything else over that period of time was manufactured housing and RV parks. So I said, that's interesting. I've never done one of those deals. So I start reaching out to the brokers in that space with my little pitch, say, hey, I can help you win the business. I'll take the exchange. And I noticed a couple things. I noticed there weren't very many brokers in that space. The brokers who were in that space, in my opinion, were either not interested in that collaborative model or candidly just they weren't a specialist, or maybe they weren't that sharp, or it was just a different animal than I was used to. So I started thinking, this is a huge industry. Why are there not more people doing this? So I hired a couple guys on and said, hey, just go start calling RV parks with this pitch and let's see what comes back. And it didn't take much time at all for that pitch and that offering that we provided to really resonate with folks, because they'd never really had a full start to finish, cradle to grave offering that was going to allow them to exit their management intensive property and exchange 100% of their proceeds into something else that's going to pay them for the duration of their life. And then, the final punctuation mark on that sentence is, most of my clients in that space were older. They'd been in the business for a long time. And morbid as it may be, they're very realistic about the fact that, one day they're going to die, and it's their kids who's going to get their portfolio. And when that happens, their kids can either inherit an RV park, which has all the headaches and hurdles, which we're going to get into, or they can inherit something like a 20-year Starbucks, which is bulletproof credit, super passive, much more liquid, much easier to sell. And they get that step up in basis that's super valuable to the kids at that time. So just from the very first conversation all the way till that final product being delivered and those taxes being fully avoided, it's a wonderful process. It makes a lot of sense for a lot of people. And that's probably our core focus today, or it was our core focus at the time. We've obviously expanded now to starting North Star, which is an outdoor hospitality focused brokerage. So we do a lot of deals that don't involve a 1031 exchange, but that's really the bread and butter. And as far as I know, we're the only group in the United States that offers that.
Yeah. So the starting point for you and still is that, so you're still brokering or finding the long-term triple net lease on the backside, or is that not part of North Star?
It's absolutely a part of it. It's just not a component in every single deal, because some people, they want to go to cash. Some people don't have too much of a capital gains and depreciation recapture tax exposure hit that they're going to take. Some people want to do an exchange, but they want to go into another park. So we'd love to help them with that if we can, if we can add that value. But really, I'm never going to exchange somebody into something like a DST or something that I don't know anything about. I'll be very candid and say, hey, I probably know more than 99.9% of people at this one particular thing. But if you're not interested in this one particular thing, let me introduce you to some people in my network that might be better suited to help you out.
Yeah. And tell us a little bit, are you only in Texas? What's the geography look like now?
Right now, we're primarily in Texas. So we have some deals we're getting done. We've done recently and getting done in some of the surrounding Texas markets. Arkansas, we just closed our first deal. Not New Mexico, Oklahoma, we're working on some transactions right now. We've got some irons in the fire in some markets like New Mexico, Colorado, Missouri. But for the most part, we're Texas centered, and we're actively growing. So we have our eyes on the states that we're most interested in. If we're having this conversation in a year from now, we're definitely going to have deal flow, if not some actual physical representation in some different states.
Awesome. Well, that's the nuts and bolts of how we got here. Let's jump trains of thought real quick. Maybe something a little more fun. Tell us what your, we'll call it, most interesting transaction has been. Maybe it's the creative structure that you put in place. Maybe it was the two buyer seller players. Maybe it was the property. What stands out in your mind as one of those stories you would tell around the campfire?
I mean, I could make a pretty good story out of most of our deals, because as you know, it's like a total box of chocolates by the time you get started on one of these transactions, and the people involved and everything from start to finish. But the easiest one to pick is going to be one of our biggest deals of the last, say 12 months, which was a deal called Royal Palms in Austin. This is a premier, institutional caliber asset that we listed, procured offers for, and then closed, and then executed that full 1031 exchange on the back end. What's unique about this deal is we were the third brokerage group to try to take this deal on. Two other groups that had the listing on this and were unsuccessful in getting it sold for various different reasons. And we took it on. with all the challenges with the property, with all the challenges with the ownership and what their goals were. And quite frankly, we've got a really dialed in transaction process. We just ran that process to a T, which resulted in Texas is a non-disclosure state, so I won't reveal specific numbers, but a multi-deca-million-dollar sale for my client who had owned that property for 40 years. His capital gains tax exposure was pretty much based on the full value of the property, which was going to equate to about $9 million in taxes that he was going to have to pay. And we said, hey, you don't have to pay those taxes. We can roll you into a portfolio of net lease properties. And we walked through that whole they didn't know anything about net lease properties. And I think for like half the time we were working together before they even wrote that first offer, they were still thinking like, so what do I have to do? How do I run a Dollar General? Like, how do I run the C-store? We're like, no, that's not how that works. You don't run it. You just own the real estate. They run it for you. But we ended up successfully selling that property at a record-breaking cap rate, record-breaking price per pad. I would say top 5, if not 3% in the state of Texas. Got a really, really good deal after a very competitive marketing and offer negotiation process. And then he ended up less than 3 months later owning a full, very well diversified, very good portfolio of net lease retail, including properties like AutoZone, CVS, several high credit convenience stores, Dollar General, a collision shop, and just a really, really good bulletproof portfolio, high credit tenant, really rock solid leases in very, very good markets in Texas. And the kicker is, which is very rare for these exchanges, is that his net cash flow out of that new portfolio is on a year one basis was 17% higher than his very best year operating Royal Palms. So it typically doesn't happen that way. Typically you're making a slight concession on your actual net. Yeah. But it was such a high class property. It traded for a very low cap rate. It was feasible. And now he's got this portfolio that's just cash flowing like a monster. His weighted average lease term is almost 18 years. So he's really not going to have to think about much for the next 18 years outside of some major disaster on any of those. But if there is a disaster on those, they're backed by companies like AutoZone, CVS, and a bunch of other high credit, historically very bulletproof concepts. So that's a banner story for us. That's the case study we take into a lot of conversations. And there's so many deals like that out there in the marketplace. I would encourage you, as you're out there on your acquisition escapade, when you find that prototypical client, say, hey, I know a guy that can help you out. And in most cases, absolutely help them out.
We actually, the challenge we run into all the time is when we talk to someone who might be at that same point in their career, life, etc. And it's I don't know what I'm going to do with my money, right? I don't know what I'm going to do next. So I think it's a phenomenal, path or solution that you've laid out there where they can still be in real estate, still get the depreciation, get the 1031, get the cash flow, give up the headache, right? Because we all know that's the big, I would say, elephant in the room here in the RV industry is that great high cap rates, lots of cash flow, lots of appreciation, all that stuff. But they're a bear to run, and to run well. So, that's it's a cool path that you've laid out for people. It's a great option. Okay, so jumping forward a little bit, maybe today's market. That's what everyone wants to know. What's happening? What's going to happen? Interest rate just changed a couple of days ago. Boom's over. You're talking, let's say, I'm not going to ask you to forecast the future, but let's just say today, and you're talking to a potential buyer. What do they need to know? RV park buyer. They want to buy an RV park in Texas. What is it that they really need to know going into this process that maybe other people are afraid to tell them?
Let's say two things. You need to know your numbers and you need to know your market. And by market, I'm going to loop in like having a solid operational strategy and that. Start with the numbers just because you have to actually understand how an RV park operates. I see P&Ls for RV parks and other outdoor hospitality assets every single day. I would say less than 10% of the time am I seeing a true profit and loss statement that is an accurate depiction of how that park actually operates. There's usually a lot of things that are missing. So we have to go in there and do our own initial audits of the financials and plug it into a model that actually makes sense and works.
What are those most common missing things that you see? I know which ones I see, but what?
Well, repair and maintenance is one that usually gets underrepresented. Management costs are usually, or it can oftentimes be a lot lower because it's an owner operated type deal. They're not technically paying themselves like a management or operational salary, so that gets deflated. We usually have to increase that. Oftentimes it's just little missed things like they didn't put property taxes on there, or they're not factoring in a property tax recalculation when the property sells. Yep. Is a big one that we have to. In Texas, it's hard because, again, we're non-disclosure. We got 254 counties who all view that differently. Some reassess very aggressively, some don't reassess at all. So both buyer and seller are taking a little bit of a risk on that, on what that recalculation needs to be, because either side either has to overpay a little bit potentially or give a little bit up sell side. And there's no way to guarantee either party is right. So that's always a point of negotiation. And then things like insurance too, like you have a pretty strong presence in Florida. And Florida has been a market specifically just like Texas, especially in the coastal markets of Texas, has been just ravaged by increasing insurance. And I sat down and had a really long conversation with Evan Rowley, who runs Rowley Insurance now. And they focus on insurance for RV parks specifically. And I really wanted to get from him like, hey, what can a buyer expect their insurance to do in the next 12 months? And this is a guy, he's a third generation operator in the insurance business. They've been in the business since I think the 60s or very long time. And he, after a very long, very eloquent, very educated answer, the summary was kind of like, we don't know. Like, we don't know what's going to happen next. So there's all sorts of things that you just can't miss on the underwriting sides, but there's also things that you can't predict on your pro forma. But right. I think if I'm actually talking to a buyer today, you could be the best underwriter. You can make the best assumptions. You could be a spreadsheet junkie, which I would consider myself one of those. But at the end of the day, if you don't know how to run a business, if you don't know how to deal with people, if you don't know how to master your market, if you don't know how to market effectively, if you don't know how to mitigate your own costs, drive revenue, diversify revenue streams, that is the market that we're stepping into right now. I don't have the crystal ball to say what's going to happen in 12, 24, 36 months. But what I do know is with all the competition that's out there, both on the physical parks, like the number of physical parks on the ground, but also there's a lot of sophisticated operators who are coming into this space. And if you're that owner who's been running one playbook for the last 20 years, your rent roll is on a legal pad, and everything is your cousin's doing the repairs to the water lines and the plumbing and all this stuff, and you're doing the repairs when they come up. There are just so many good, sophisticated operators stepping into this space, and there's so many new vendors that are stepping into this space that are aiding in RV park operations, whether that's from a management perspective, from a marketing perspective. There's just so many things that you really do have to know, and you can't rely on anybody else to know for you, especially and including third-party management. You manage a lot of parks. Third-party management, property management in general is a tough business to be in.
Very tough.
And to rely on your property manager, third-party management, or just an on-site manager to be proactive and solve all these problems for you is a mistake you don't want to make. Like, you really do need to be the operator of your business. You need to be on the forefront of all these changes, whether they're legislative or technological changes. Like, you need to be the boss of your business, because I can tell you a handful of operators in the state of Texas who, if I had to hire someone to own a park for me or run a park for me, my list would be very short. But that short list is a powerhouse of knowledge, hustle, of effectiveness that is very, very rare in this space. And it's only getting more competitive. So you've got to be willing to roll up your sleeves and do the work.
I couldn't echo that more, right? That's why we self-manage at first, and why we're now can provide those same services I think you're referencing there to other owners as we grow and go. Because I think my take on this is you can run probably 1 to 3 properties pretty well, most people, and get by and do okay. But that jump from like 3 plus means you essentially have to either form your own company, management company, or hire a third-party management company. And if you're going to do it yourself, you really don't have the scale still, right? So it takes, like, my opinion, somewhere around 12 to 15 properties before you can effectively have a management team staff. So that, like, 3 to 12 range is a pretty dangerous spot for an owner to be in if they're not partnering with a good management company. If you're going to do it yourself, I guess is the best way to think about it, right? Because you're going to have people cost a lot of money, good people cost a lot of money, and to be able to manage, more than a couple, that's going to be an investment into your company that you got to be willing to make, just like your investment into the property itself, to get there. Okay, so what would you tell a seller right now? What's the market look like for them?
That's a trickier one because I'll speak to Texas. I know Texas better than anything else. Texas is a massive state, and Texas has a lot of different types of parks in different markets, in different climates, and different topographies, near different features, near different industries, who all cater, who all operate in a different way and cater toward a different demographic, and that is changing overnight. Like, right, like, I'll give you an example. Just outside of Houston, on the south side of Houston, is a horrifically depressed market for a period of, like, basically throughout the entire Biden administration, since they off a lot of that liquid natural gas production out there. Parks went from 100% occupied with a waiting list to like 30% and barely breaking even, or not, in a lot of cases not breaking even. So really understanding your market and what the longevity of your market looks like. Another example is the Abilene market. Abilene market, my team and I, we kind of avoided for a little while when we first got into business because it was so sluggish and so brutal. And it was very tough to make deals work, tough on the operator side. Now there's massive data center projects going in out there, which is bringing in a lot of workers, either directly on the data center projects or on infrastructure upgrade projects or on like power grid improvement projects, all the way down to all those supporting industries that are going to support that new population growth. Now that market's just exploding and those park owners are doing well. So if you're the operator, you're the owner, you need to think, hey, what's my plan for this business? Do I want to grow to get from my 3 parks to 12 parks like you're talking about? Do I just want to maintain what I've got? Do I have an off-ramp in my future? What's my timeline for that? And you really need to start thinking critically about, am I in a growth market? Am I in a stagnation market? Do I have too many of a certain type of renter that renter might change, especially if we're talking like a oil and gas market like out in West Texas. I'm from West Texas. I've seen the booms and the busts. You can be one day making money hand over fist, and then price per barrel goes negative or just changes drastically, and then everybody clears out and goes somewhere else. So think about the longevity of your property. Think about the value today and really how long you want to be in the business. Obviously focus on your operational plan and operational efficiency, but everybody in some way, shape, or form is thinking about their own exit. The last thing you want to be is the person who is not thinking critically about that, and then you're finding yourself needing to exit for one reason or another in a down market or in a bad market or in an oversaturated market or whatever the case may be. And that really just takes being very plugged in on a lot of different fronts. You talked about like the capital market side, interest rates went down. That's very exciting for a lot of owners. Right now we're in a period of time where there was a lot of cheap debt put on RV parks between 2020 and say first half of 2022. I've seen plenty of 3 and 4% interest rates. And guess what? Those are commercial loans. They mature in 5 years. 5 years is right now, between right now and 2027. If you are at a 4% interest rate and now you're looking at having to refinance it at 7.5+% interest rate, that's going to have a pretty big hit on your cash flow if your revenues haven't grown proportionally. So, and if you're thinking ahead, you're thinking, okay, do I want to be in this business in the next 2 years? If the answer is no, well, I should probably try to sell to get way ahead of all these refinances. Mm-hmm. Because if someone decides they don't want to refinance and hold their property, their other option is to what? sell their property. And you don't want to be trying to sell your property at the same time everybody else is selling their property, which is a little bit of a condition of what we're experiencing right now in Texas. We've got one of the highest inventory numbers of parks available for sale in Texas that I've ever seen. And it's mainly driven by that there's a lot of there is a lot of delinquencies and some foreclosures that we're foreseeing, but a lot of people are just deciding, hey, this is harder than I thought it was. This is a lot harder to operate these now than it was in 2021. Maybe it's a good time to sell. Well, guess what? There's a lot of other people having that idea as well. So you either need to kind of plan to ride that storm out, operate efficiently, or say, hey, I can see the writing on the wall. I might want to exit while pricing is still really good and not have to roll the dice on what things might look like in 12 or 24 months from now when all that debt comes due,
Yeah, you mentioned 21 and 22, the years, a couple of times. A personal pet peeve of mine. Love to get your take on it, particularly from the seller's perspective, or if I'm the buyer. Usually, it's like, hey, look what this property did in 21, 22, and I know that the property down the street sold in 2022 or 2023 for this price per pad. How do you bring reality back to that seller?
Well, I'm a data.
What is the reality? I guess, what do you think the reality is today?
Well, the reality is, all things equal, your property is objectively worth less today than any other property was in 2021. That is interest rate driven. That is supply and demand driven, both on the number of RV travelers and on the number of parks on the ground. Right. So I'll think, but I don't think there's very many circumstances where a park today is worth more than what it was in 2021. So what I'm telling those people is, first off, I'm just a data junkie. I treat everything as much as we can in this industry. There's so many subjective factors that I try to really hone in on the objective factors. And I look at the numbers. I look at the comps. We track every single listed property and sold property in the state of Texas religiously. I've got a person whose sole job it is to track that stuff for our company. So when I'm doing a proposal to an owner and I tell them the value is worth X, I'm not just saying it's worth X. I'm saying, here's what your debt options look like. Here's what your occupancy looks like. Here's what that factors into on your current revenue, your pro forma revenue. Here's what your competition looks like in the market. Here's the last 6, 7, 8 comparable sales that have taken place in this market over the last 6 months. All signs point to this being the value. And yes, I do understand that that's 30% less than the cash offer that you received from XYZ publicly traded company back in 2021. But at the same time, there's a lot of things that have changed. So a part of our conversations, a big part of our conversations with owners is just education around the market. And that's a dual thing. I can learn as much from them as they can learn from me, but it's to show them all this stuff, which, unless you're someone like me who tracks it religiously and understands it very well, you're just kind of guessing as a seller who doesn't track the market, or as a broker who maybe doesn't specialize in this. But when we can bring all that data and knowledge and case studies and examples into a conversation and show them, here's what it is, there's very few instances where we're incorrect about something, or we're massively missing something. We never overprice or underprice anything. Our pricing is very accurate, but it's accurate because like I told you before we started the call, we've got 19 active listings right now. We're negotiating terms on almost every single one. We know what buyers want. We know what they're expecting. We talk to banks on a lot of our deals, so we know what they're willing to underwrite at and what their underwriting standards are. And if I'm talking to somebody and I say, hey, your park is worth, this is an actual example. If I say, hey, your park is worth $5.5 million, and they come back and say, well, the other broker says that they're going to list it for 8.5, I got to go with them. I say, go with them, but I will expect my phone to ring. And on that particular example, it was on and off the market with 2 different brokers before he ended up calling me back, because the brokers just didn't have the access to the data that we have to really show how that process was going to play out over that probably 12 to 18 month time span.
It's good. It's a different world, and we have to kind of get past that. And I think equally on the buyer side, you got to be very careful on the underwriting, right? You can't, you got to, as you said, understand that P&L clearly, specifically by the month. Even the months are important, that you understand that trend. but you can't simply compare or fool yourself to say, well, I did this a couple years ago, we can do it again. Maybe, but unlikely that you're going to have that type of, I would say, unnatural forced demand that COVID produced, right? So I think it's a certain level of discipline that's just required nowadays to keep going and keep doing it. So what, there's, I assume a lot of people are going to value a park based off of a cap rate, right? An NOI and a cap rate. How do you balance that? And I'd love to get your opinion on, what you think the market cap rate is right now for different various asset types. And then on the flip side of that is the two metrics I'm looking at are the cap rate. And then I'm also looking at the pure price per pad, right? What's the cost, the price per pad? And I think both of those have to factor in. If you go purely one direction and only use cap rate as a valuation, that's going to be skewed. And similarly, if you're purely a price per pad situation, that's going to cause some situations. So love to get your take on, how do you come up with valuation based off of those couple metrics?
Absolutely. And first off, I couldn't agree with you more. You have to look at both. I could go in so many directions with this, but we look at the cap rate first. We pull comps from the cap rates. We understand what the cap rates could be, what that could turn into on a cash on cash basis. What's the loss to lease? Is there actually upside that someone could maybe pay a little bit of a premium on based on the cap rate? And try to make a determination that way. And then on the price per pad side, it's equally as important, but you could have two identical parks in terms of construction in two very different markets. And one market could be a $500 a month lot rent and one market could be a $900 a month lot rent, which just mathematically equates to very different price per pad. So you have to take both into consideration, and you have to be able to explain that to both a buyer and a seller, as well as all the other intricacies. So our underwriting process is pretty grueling. It's pretty dialed in now, but we have a checklist of, I don't know, like 50 or 60 different like KPIs that we track every single time we start on something. It starts with a market study. We want to know what the market rents are. We look at ours. Do we have a loss to lease? What's our gross potential rent? What's our physical and economic occupancy? What's our operating expense ratio and net income ratio? And then just reverse engineer into that. But even the cap rate conversation can be skewed, right? Because it's very easy and mathematical to put a cap rate on a park that derives 100% of its revenue from RV rentals. However, there are so many different parks that have an RV component, and then they've got maybe like a tiny home component. They've got some park-owned structures and some tenant-owned things as well. Maybe they have a substantial portion of their revenue that's coming from things like kayak rentals or camping, which objectively shouldn't trade on a cap rate multiple. It should trade more on like an EBITDA multiple. So you have to bifurcate those, value them separately, and then combine them back together at the end, because that's how a bank is going to do it if they're going to underwrite and issue that loan. That's kind of why we ended up, like, we started with RV parks, and now we do a whole gamut of different things, because there's been very few instances where we're selling something that just has an RV component. There's usually an RV in a mobile home, or RV and tiny home, a camping component, or storage component. Even in our most recent case, it's a marina component, right? So we have to figure out how to value and cap out a marina. So you really have to break everything down to its just base level fundamentals and its core principles, and then rebuild it back up from there, and then provide that valuation. And I think our biggest hurdle in doing that and really conveying that to an owner is just, we have the benefit of a lot of experience. And if they're talking to other brokers, or if they're talking to maybe like an off-market buyer, they're not looking at it the same way, which ends up getting a lot of people in that same situation that I mentioned you. Well, we quote a price of X. Somebody else goes X plus 30% for whatever reason. And then if they win that listing and win that business, guess what? It ends up trading right where we said it was going to trade, because that's where it's economically viable to do so. So you're absolutely right. Both are important, but neither one can operate alone in a vacuum without pretty heavy consideration into the other.
Yeah. I've seen deals where the cap rate justifies, a high hundreds, high, like almost $100,000 per site. And I'm looking at this is dirt roads and gravel and trees and septic systems and water. I'm like, I get it. The cap rate would say that you should be there, but there's an upper limit to just the intrinsic value, replacement value cost of what's there. And conversely, right, if a property is distressed and it has no NOI, right, it has no cap rate, well, you don't get it for free, of course. So there's just a common sense, I think, buffer that has to be in there.
Yeah.
You mentioned something pretty interesting. Go ahead.
I was just going to add one thing, and where that's most notable too is if you've got revenue that's most heavily derived from long-term renters versus short-term renters. I remember looking at my first P&L for a KOA, which was almost exclusively, in this case, was short-term rentals. And I'm just really scratching my head. I'm like, how is your revenue 3x what a typical RV park of this size and quality is doing? That's because their ADR is just through the roof as compared to a long-term rental park. So the price per pad, it looked super inflated. It didn't comp out on a price per pad basis, but on a cap rate basis, it made sense.
Yeah. And then you have the expense side of it, of course. And like you mentioned, there's very few parks that are just an RV park. Like that would be a dream to look at and underwrite there. It's always got a restaurant and a marina and some type of other things there. And bifurcating the revenue is not necessarily easy, but doable, where I think we see the real struggle, particularly when you're talking about building an EBITDA for the restaurant or building an EBITDA for the marina or whatever it is. And there is that the expenses get really complicated because they're generally always shared across all the different type of channels, let's say. So the restaurant manager is also probably the GM of the park, and the maintenance guys, right? Of course, they're doing maintenance on the whole park. How much of that do you allocate towards? So that's always been our struggle, not necessarily to figure out where the revenue is coming from, but how do you allocate the expense side of that to build your separate valuation models? Any tips or tricks on how you guys go about that side of it?
I'd say that goes back to the conversation with the park owner and maybe future seller is if when you're running your P&L, please, all park owners, if you hear one thing, keep a P&L and keep it accurate. We understand that some people pay in cash, and we understand that cash can just be reallocated elsewhere. But when it comes to actually selling your park, you need to be able to verify that. The best thing that someone can do to help me out is to make sure that on your P&L under the revenue section, you've got revenue for lot rent, and best case is you've got it for monthly, weeklies, and nightly, so we can see what that breakdown is. And then how much is coming from the store, how much is coming from propane sales, how much is coming from golf cart rentals, kayak rentals, the restaurant. You got to be able to break that down because there's no restaurant in the world that's going to trade on the same multiple as a park would on a cap rate basis. So you can't attribute that income in the same way. It's got to be broken down differently. And best case, if I'm really giving you my Christmas list on how an RV park owner should keep their books, keep multiple different P&Ls, keep one for the park, keep one for the restaurant, keep it all separately so you can itemize and isolate your expenses as well, because that's going to make things so much easier when it comes time to sell. And this too, if you're a seller, you're never going to get the benefit of the doubt. If you can't show your numbers on the revenue side or the expense side, you're not going to get the benefit of the doubt from the buyer that it's best case scenario. You're going to get worst case scenario and the most conservative. Mm-hmm. Even if the buyer does agree to it, they're going to have to go into a bank and convince the bank. And banks are, you deal with banks, I deal with banks. They're not giving you the benefit of the doubt either because they're locked into that loan for at least 5 years. So really just keep good, tight books and records, keep an income and expense statement, pay your bookkeeper $200 a month to keep everything tight and organized for you. The $200 a month you spend on a bookkeeper is going to pay dividends when it comes time to actually moving the property on to a new owner. Yeah.
It's a shameless plug, but we do see a lot of benefit that we bring to other owners just in that side, bringing sophisticated bookkeeping and controller and all the systems and stuff in place. And then going from sometimes literally pieces of paper and shoe boxes of receipts, and then through over time, operating and working through the revenue and having a real P&L, even if the numbers didn't change, that changes the value of your property just by having good bookkeeping and bringing that process to date. We've made a lot of money. I've made a lot of money by buying shoebox receipts and running it for a year. I probably didn't change the revenue much. I probably didn't change the expense much, but I could prove what was there, and then thus that person, the next buyer, could get financing, and therefore the price goes up, right? So whenever you can get debt, particularly bank debt, which is always cheaper than most other private debt, then you increase the value of your property just by operating it the right way.
Absolutely.
Yeah. So, what deal are you most excited about right now?
We got some good ones going right now. We've got the Lake Waco Marina and RV Park listed. We're negotiating offers on that right now. It's my first true marina deal. That's been a really fun learning lesson, a very big challenge. We've got several that are going to be cradle to grave, RV park sale, 1031 exchange, replacement portfolio of retail lined up. Those are always big deals for us. And those are the deals that I always feel best about at the end of the day, because we do make commissions off of those, off the sale of the property and the acquisition of the property. But at the end of the day, I know that I'm saving someone usually to the tune of several $1 million in taxes and getting them a property that they're going to be happy with long term. I won't say specifically which deals, because those are active deals.
Sure.
Our other exciting deal that we're getting a contract put together on right now is actually not an RV park. It's a massive campground portfolio south of Austin. And this is where we really had to sharpen our pencil on the separation of the revenue streams, because you've got safari tents, you've got gazebos, you've got a whole tubing operation that runs between two of the parks. All these different things need to be valued differently. And that's a multi-decade $1 million transaction for us. It's been a challenge. Finding a buyer for something like that in the first place is a challenge. Finding a buyer who agrees on the pricing is a challenge. Finding a bank, good luck. So there's a lot of stuff we're really excited about that we've got active right now. We've got some stuff in the kitty that will probably, get started on maybe Q1 of next year. That will make 2026 a very fun and challenging year for our whole team. And our entire team is involved on almost every single transaction in some way, shape, or form, from the transaction coordination to the actual screening of phone calls and prospective buyers, to debt procurement, to the research and underwriting side. So we all have to be on the same page and in lockstep. But we like working that way. It makes it a lot more fun if everybody's got a vested interest and everyone's kind of pushing toward that same North Star goal.
North Star. Is that where the name comes from?
That is where the name came from, yeah.
Nice.
I didn't hit on that, but we had a dickens of a time trying to come up with a name for our new company. And it was actually my mom who threw out the idea originally, but she threw out the idea because what I've been pressing on my team from day one is hey, if you want to get deals in this business, if you want to represent your clients well, you need to really see yourself as their partner. You need to understand and define what their own North Star goal is and say, hey, now that's my goal. I'm going to go out there and help you get that. And that's an integral piece of every single new client that we take on, every single pitch that we get on. And it resonates. It's a great name. And I got to give my mom for it. Yeah.
If your mom comes with it, it can't be bad, right? Whose mom is ever wrong?
Exactly. That's right.
Yeah. All right. One more technical question, and then I'll wrap it up with a personal question for you. Some of our listeners, maybe a lot of the listeners, want to become park owners. They're not yet park owners. Admittedly, it's a little bit tough to break into the industry and be taken serious, right? When you have no portfolio. So what can they do? What things are you looking at? Because let's be fair. You as a broker are vetting the buyer as well too, to decide if you even want to work with them as a client, right? And it's not like buying or selling a single family house where you just call a realtor and they take your business. You may not, or a seller may not, work with a buyer no matter what they say they want to pay for it. So what are the things but we all started somewhere, right? So we all have to have a starting point. So what are the things that someone who has never bought a park, what can they do to be prepared? What things should they say or not say? What would give you comfort in accepting their offer or working with them as a non-park owner yet?
Well, what gets me comfortable with someone is credibility and track record, but that's not the question. If we're a first-time buyer, you should endeavor to be a student of this industry, and you should really know what you're talking about. And that can either be a self-learned thing, or you can learn that from partnering with somebody like us and kind of run an acquisitions process for you. I'd be actually curious to get your thoughts on this as well, because what I've noticed on the buyer side right now is that there is this massive wave of creative financing interest that is almost overwhelming in how many phone calls I get on my properties. And then the very first question that gets asked is, hey, is the owner willing to do creative financing? I'm not saying I've got the most experience in brokerage, because I obviously don't, but in my experience, if you're a buyer of any type of product, you typically define what you want to buy, define the price point that you're looking to buy in, define the region, the geographical region that you want to buy in, and then you go find the deal. And then once you found the deal, you put together your financing on the back end in terms of what makes the most sense. Maybe you can get bank financing. Maybe you can talk someone into seller financing. Maybe it's something more creative like a joint venture or something like that. That's what I'm used to. And what I'm seeing now is people from all over the country are almost doing like a spray and pray model with this, hey, creative financing. Let me tell you about this unique structure that my mastermind group does. Do you have any properties that will be suitable for that? I'm like, I can't just go ask all my clients, would you be interested in this one particular structure? Because I don't know anything about you. I don't know what your credibility is. I don't know why you're interested in this particular property. Again, like this park caters to a very different type of renter than this park. And it's to me, it's kind of like putting the cart before the horse. It's like you're trying to put a square peg in a round hole in terms of the way that you're going to finance a deal before you've even financed the deal. So if I could tell a buyer how maybe to look at things that's going to at least make my life easier. And if my life gets easier, you get easier access to properties. It's define what you want from a property first. Right. And then you can figure out the financing on the back end. Don't lead with the financing, because at least in my experience, that's the surest fire way to show me that this is your first rodeo. You're not exactly sure what you're doing, and you're just trying to find something that fits your model. And oftentimes that's not like you might legitimately get a better deal if you go with a bank route, if you go actually get conventional financing, or if you pursue something different on that particular deal than this one very narrow lane that people seem to be having right now. So I don't know if you've seen similar things in your side of the business, but it's overwhelming on our side.
Yeah, and it's very definitive. Like last couple months of essentially. Oh, well, we all know who the name is, I think, behind it. But it's that works in single family house flipping. Let's just call a spade. When you go out there and there's millions and millions and millions of houses to buy, and you spray and pray and run it, and you find opportunities there, and you find the creative financing, and you can do that, and great. I don't think it's smart or intelligent to take that same process and apply it to, realistically, there's maybe 3,000 to 5,000 parks in the US that are sellable at any given point, right? There's maybe, I don't know, there's only like 15,000 total. And, for me, there's probably less than 1,000 that I want to buy to start with. But at the end of the day, like you're a professional broker, it doesn't come across good for the first question you ask is, will you sell or finance, right? And it does not build credibility, particularly if you have no credibility. Now we have bought, I don't know, probably 10 up to, close to 10 of our deals that we own are seller finance or some creative finance. That's awesome. I think people should know that. They should love it. It's a great way to structure a deal, and it happens a lot in RV parks, no doubt. But yeah, you're kind of tipping your hand right now, particularly with the flood of these crazy offers that come in, and that's your first offer. I've told blatantly a couple of brokers I'm working with on potentially selling some stuff. If it comes in and it says that, don't even bring it to me. I don't want to hear it. Or do some research on that person making the offer, and if it's in their profile picture, I'm not going to waste my time even responding.
Or if they were a soccer coach 8 months ago and now they run a whole acquisitions and management company, it's like, wait a minute, how did you build all this credibility in 8 months after coaching like high school soccer 8 months ago, which it's actually a real example. I'm not going to say any names. I don't remember the names, but you gotta.
Well, it's tough because I want started with nothing, and I want people to do that, and I want to help other people get in this industry. So I don't want us to come across like, hey, we're here and you can't come be part of our club. We've made it, and this is not for you unless you've got all experience. And how do you get the experience? But that's why I asked the question. I'm trying to give real concrete, solid advice that is true. Maybe not what you want to hear, but true, that actually does help someone who really wants to get in this business to get started. Because everyone has to have their first deal. So I'll rephrase what you just told me. Worth the deal before you start working the financing side of it. Understand what you want to buy, do your underwriting before you go down this creative financing route.
Yeah, understand what your buy box is. Like if you're someone who says, we'll look at any deal. I say, what's your price range? Anywhere between 1 and 50 million. What's your geography? Anywhere in the United States. I'm like, do you own any parks? No, we don't own any parks right now. It's like, yeah, I know you don't own any parks right now because you would never say that if you own parks and if you were actively and seriously buying parks. And I try to, I'm a very understanding person because in a lot of conversations, I'm the idiot. So I appreciate when people are patient with me. So I try to be patient with everybody and kind of explain how this works. I'm never going to bash anybody for any reason, but that is really a cornerstone. And I was saying, I'm going to be too nice to say it. There's been times where I have been very close to being a little bit more direct, but that is the cornerstone, is understand what you want to buy, what you can actually buy. Mm-hmm. Don't just ride this wave of hype, because there is such a wave of hype around this industry right now. It's easy to get sucked into it, and you can go look at any other industry or product type that has caught this wave of excitement, and then eventually that crashes out. There's a little bubble that pops, things change, fundamentally change, and the market doesn't look anything like it did. And if your only exposure to an industry is 8 months, then you don't have any time to see anything close to a full cycle or the rise and the fall. I've already seen rises and falls from a macro perspective and in certain micro perspectives in certain submarkets. And that's not something to be taken lightly. You really need to be thoughtful about where you're going to spend money. And then especially if you're spending somebody else's money, if you're syndicating funds, I've seen a lot of syndicators just burn their co-GP and their LP's money YOLOing into a deal that, just one example, there's a deal, again, won't say names, but there's this acquisition group based in Texas. They've got a very strong online presence for their syndication, and they do these big webinar calls and stuff like this. They called me one day and said, "Hey, Landon, we've got this park under contract. We'd like you to look over the numbers." Like, sure, I'll look over the numbers. They send me the numbers. Beautiful park, Class A park. It's operating like a 30% expense ratio. It's in a market that's just not it's in a very flat market type of a deal. And I just happen to know the owner. The owner's a big time developer. They develop parks, and they've got their own construction company, asphalt and paving company. They can build parks cheaper than anything else. They conveniently owned all the surrounding land as well. And I made some mental notes of this. So when I get back on the phone with these guys, I'm like, okay, what are you under contract for? $7 million. $7 million for a 100-space park in kind of a nowhere market, Texas. And I said, okay, guys, let me just run some things by you. You're paying $70,000 a pad for a park that's being purchased at a sub 6% cap rate, which right there is crazy. No, excuse me. It was a 7.5% cap rate based on a 30% expense ratio. So I showed the P&Ls here, the things that your P&Ls are missing. If you adjust this to a market, let's just say 40 to 50%, with my assumption, your cap rate drops down precipitously. And their counter was, well, you don't understand, we've got great seller financing on this. It was 0% interest, 5-year term, whatever. I was like, it doesn't matter. Your basis is what your basis is. There's not a path where this is going to exceed $7 million in the next 5 years. So my advice to them was don't buy the park, because I think that realistically, if nothing changes in this park's probably worth like $2.5-3 million. Let's just say $3.5 million. Didn't take my advice. That's okay. They end up closing on this park, and then less than 12 months later, they call me and says, "Hey, Landan, can you get us out of this park?" Like, send me your P&Ls, see if anything has changed. Nothing has changed. Park's bleeding money. The actual money that they spent to get into the park was very low because it was a high LTV seller finance deal. Let's just say it was $2 million. That's $2 million worth of LP money, and there's no way that they're going to ever clear that park for $7 million again. So that money is just wiped out. It's gone. Mm-hmm. And there's so many of those stories that I could tell you. That's the risk that you're running in general from a seller's perspective. He's going to get that park back. He's fine. From the buyer's perspective, they syndicated it, so they didn't have any skin in the game, really. Maybe a small amount of money. From the LP, who knows even less about the market than maybe even the GP or the one putting together the deal, you don't even know how your equity just got destroyed overnight. So it's just like, if you're going to get into this business, understand, are you a GP? Are you an LP? Are you going to get into a specific geographic market, into a certain class of parks, into a certain type of rentership? Like, really have a strong understanding of what that is. Unfortunately, there's a lot of good content out there, whether it's articles on our website, whether it's videos from other people, that is actually truly informative information and not a acquisitions funnel for some mastermind group so that you can buy their course and then you can be in that system. There's plenty of good resources out there where you can educate yourself. Don't rely on anybody else to tell you how you should spend your money and how much you should pay for something if you're spending that money, because it's just so easy to get burned in a market that's as dynamic as we are. And at the end of the day, these aren't mobile home parks. Like, it's not an apartment complex where the asset is the asset. It's not a mobile home park where it's still pretty sticky and tough to move things. If you do something wrong as an operator and you tick off all of your residents there, you raise rents or whatever, guess what they have to do? Fire up the truck, drop the hitch on the truck, go 5 minutes down the road to your competitor, and you just lost half your revenue overnight. It's that easy to lose in this business.
And I think it's the same on the development side, right? As you mentioned, particularly in Texas, if you're a construction company, you can build these things out maybe $15,000, $20,000 a site. So I think that's why the basis to me has always been so critical. We look at cap rates a lot, but any high, and high to me is like anything above really $60,000, $70,000 per site basis makes me very nervous for those reasons. Like, your customer can leave quickly, and you can have a competitor come in and build very quickly. Now, cost of construction has went up significantly over the last 5-10 years. But again, any place like Texas where you have obviously an immense amount of land and sometimes little to no, zoning, permitting, entitlement issues. In Florida, we have a lot of land, but it's a fight to get anything entitled. So there is some barriers to entry there, but that's and I think that's just a really important point to drive home to people. There is the numbers, like you said, you have to know them to the dot, and you have to know the rule. You have to know when things out of whack. If I look at a P&L and it has a 30% expense ratio, immediately I don't care, because there is something missing. No park runs at a 30% expense ratio, right? So have to know the numbers, but then I think you also have to put some boundaries on there from a basis per site. You can fix a lot of problems if you buy it at the right basis. It's low. Wow. As you said, the operations can go backwards too. Buy it at a low basis, vacant, dilapidated, no cap rate, whatever. Well, put some good operations in there, bring it in, and then now you've really created a lot of value for yourself.
And to your point, there's been a tremendous number of RV parks, nice RV parks developed in Texas over the last 5 years. Mm-hmm. The prototypical person who builds those parks is somebody with a construction or project management or development background who's like, hey, I can do this. Utilities, dirt, pads, they can, and they're not wrong. The fallacy that I try to, and those people are educated to a degree about the construction costs and building and things like that.
They're generally pretty wealthy too, and have probably developed other things. They have another thing. So it could be just for depreciation. It could be just for covered land play for the next 30 years. But sorry, go ahead.
No, that's fine, and I agree. The conversation that I beat my head against in a lot of those conversations is the replacement cost. The if I say to you, hey, this park, based on every single measure that I can walk you through right now, you're worth $50K a pad, just to look at that one metric. They get offended, or not everybody, but some people get offended. It's like, well, Landon, you don't understand the replacement cost because you couldn't build this park again today for $50,000. It's going to cost you $70,000 to build this park. And then the amount of times I've had to sit with the developer and say, it doesn't matter what you spent on. You could go build a Class A resort for $100,000 a pad in the middle of Nebraska, and it will never, ever be worth the amount of money that you spent on that park. If you don't have the cash flow that can support that asset, that can support debt service, or is greater than what any particular investor could achieve from a competing or alternative investment, you're not going to get that deal done. So yes, there is some argument toward like a replacement cost analysis, but where I have bumped into that most often is when that's like the primary metric of why they think it should be worth more, is because they spent more to build it in the first place.
Yeah, I think that replacement cost, or the basis cost, to me is much more productive on the lower limit. That's where I'll take the risk. I'm buying something at $20,000 a site, and I know that there's no way to build it for at least 50,000 a site. That's where I'll take the flyer. Yep. I'm not willing to take the flyer on the high end of that side and say, well, the cap rate supports it, or the cap rate doesn't support it, but the replacement, that's to me where, from our investment philosophy, how those things play in. Where I take the risk depends on the high end or low end based off the cap rate and or the per site cost.
And that's like, I couldn't agree with you more. That's the right way to look at it. It should not be a kind of last ditch justification as to why the price should be more. It should be, you should know your business well enough to say, hey, that's a really low price per pad. Everything in the area is worth more than that on a price per pad basis. Maybe this has a abnormally low occupancy because of some operational efficiencies. Maybe the expenses have just far eclipsed what a park like this should actually be running, and we can go in there and trim the fat. But that's why valuing these parks in the first place is so much of a science, but it's also so much of an art.
I call it fun. We'll just call it fun.
Yeah. Yeah. I like to pick up basketball. That's fun.
Well, it's a great segue. Thank you Landon, obviously your wealth of knowledge, particularly in Texas, particularly in parks, but I know that it spreads well across the border. What is it that you do? So, our motto here, one of our sayings is, disconnect to reconnect, right? So disconnecting from the things that aren't as pleasant as we want in life, and reconnecting to what we would say is the most important things. And so for us, or for me, that's like my faith and family. What are the things, what's your way of disconnecting and reconnecting?
I'm a husband. I'm a dad. I've got 2 little kids. I've got 1 more on the way. I'm coaching my 4-year-old's soccer team this season. That's a lot of fun. Whenever I'm not working, I really do disconnect. I spend as much time as I can with my family. If I'm either awake before my family gets up, or I'm staying up a little bit later, I'm staying active some way. We've got a great trail system behind our house. I'll do trail runs, rucks. I'll go play pickup basketball. I like to fish. I'm going on an elk hunt in a few weeks. I like to get out and just touch grass, breathe fresh air, get out from under these like fluorescent lights every now and then just like remind myself that like everything can change overnight, and I never want to take anything for granted. I never want to not be spending my time in my short life the ways that I absolutely want to. And like the best example for that for me was this is the first year of my company, so it's been a very busy year. And when I was kind of putting my big rocks and my medium rocks and my small rocks together in my jar and trying to figure out what's most important, what I decided on was that my biggest rocks every single week are breakfast and dinner with my kids and my wife every single day. Everything else can take a backseat to that. And it doesn't happen all the time. I travel a lot, but in most days I get that quality time in the morning and I get that quality time in the night. And then when I plug back in it's the craziness of the job. But in short, I spend as much time with those little kids as I can, because I've already seen how quickly they've grown in just a couple years, and I know that it's only going to get quicker and quicker as time goes on.
That's amazing. I think you truly have your priorities right there. Technically, this is our first year as a company from the property management side of it. As you know, like starting a company is really rewarding, really difficult, really time consuming. And one of my mentors shared something with me that was important. He's like, there's a lot of really important things and a lot of really valuable things that you need to do in your day to day and in your life, and you need to accomplish those. But there's a certain number of things that are priceless. And the goal for the hard part for most leaders is not, what's a waste of time and what's a good use of time. It's separating the really valuable from the priceless. And that's the hard part, right? That's the hard part, because we're helping people, we're doing people and growing business and creating new jobs and all these type of things and whatever else that spins off. But there's priceless things, which is your children, right? They will not slow down growing. And so, thanks for sharing that with us. And really thank you for being on the show. It's been a pleasure.
Happy to do it, man. I've been watching you guys from a distance for a while. I want to see you guys succeed. I appreciate what you're doing, which is first and foremost, you're putting together a platform and you're putting together content that helps the people that you want to serve. And as we know, there's so much of this content that exists out there in the same industry, but in different ways. It's very self-serving for the people who put the content together. And I'm guilty of that to a degree. It's like, I wouldn't do content if it didn't in some way, shape, or benefit me. But at the same time, there's no point to me doing that content if I can't actually help people or inform people or benefit somebody else's life. Because even in my most selfish perspective on that, like, that's what leads people to me, and that's what makes people want to do business with me. But that's just like, I'm young. I'm 30. I just turned 31. Like, I plan on doing this for a very long time. My reputation's everything to me, and I really do want to be a part of the positive in this industry and not the negative in this industry. I'm not some fly-by-night guy who's going to catch the next wave of excitement whenever that comes around, whatever that is. Like, I do see a long-term business plan for myself in this industry. I've got a great team behind me who are really, they're the bones of our organization, but they're also relying on me to make this whole thing work and work day after day, and early mornings and late nights and weekends. And at the end of the day, that falls on the leader's head. You feel that pressure. Really, you just have to put yourself in the best position to be the best asset for your team and your clients. And that's what's going to be the biggest derivative of your success. Nothing else. So thank you.
The evidence, thank you. Appreciate it. Thanks for the kind words. The evidence rings very clear just in this conversation that you are that person and you're on that right track. And so thank you for doing that. So let's segue and end it up with, obviously, how can people get connected to you?
I used to say just call me, but I get a lot of calls lately. So you're welcome to email me. Our website is our North Star website is the letter N, the word star, the letters B as in boy A, nstarba.com. That has links to all of our socials. We're on Facebook, we're on Instagram. I'm personally on X. That's where that's my vice. That's my social media of choice.
Okay.
YouTube, we've got a couple things out on there right now. We're trying to ramp that up, but candidly, like, the website is going to give you access to all that stuff. So start there.
Cool. Well, we'll make sure we have all those links when we post this. And Landan, thank you for being on Riches and Hitches.